Good evening.
Good evening. Good evening.
I'm Chet Thompson, General Sales Manager at Carolay 870, and on behalf of Carolay, we'd like to welcome you to the Powerwell Summit with Hugh Hewitt and his distinguished panel of experts. Very quickly, can we all just do this together if you haven't already? Thank you so much. Hugh Hewitt's taken a special vested interest in assembling this fine panel of experts tonight, and I'm sure you're going to find this an insightful evening. And to that extent, our Vice President and General Manager, Terry Fay, has written a letter to you inside this program guide. And in his last sentence, he says, "We encourage you to make this an interactive event, to learn and ask questions and take advantage of our panel." And let me tell you, with the wealth summits we've had, when the audience does the Q&A, that's when the fun really begins. So without further ado, I'd like to introduce to you talk show host extraordinaire, blogger extraordinaire, professor of law extraordinaire, and most importantly, the husband of the fetching Mrs. Hewitt. Ladies and gentlemen, Hugh Hewitt.
Thank you, Chet. Thanks for coming out tonight. This is a very special night. When Terry and Chet first called and said, "Do I want to do this?" I said, "Well, Prager always does this. I don't want to do anything Dennis does." And they said, "Well, Dennis has sort of perfected it, and he only gets like 100 people to come." So I said, "Well, if I can get 200 people to come, I'll do it." So I'm glad you came out so I can lord this over Dennis. My real motivation, though, is I do a lot of economics on my show, more than I think most talk shows do. Brian Westbury is very gracious. He spends time with me every single week, Friday in the second hour, to talk about the news that has happened during the week, to try and decode it. And I begin every Monday. I talk to Chip Hamlin from Green Faucet to look for the indicators we're going to look for. And in between, as news happens, I go out and find people who know what's going on in the market. And the reason is I find that my audience is higher income, higher educated, much more involved in where the world is. And we have been struggling through the last 2 years, frozen by uncertainty, frozen by really an unparalleled and never before seen period of pessimism. I do remember the late 70s. How many of you remember the late 70s, right? Okay. This is sort of like it, but at that point we didn't think the machine had stopped. It was just going so damn fast on inflation. We didn't know what to do with that. And when you had a prime interest rate of 13.5% and the first house we were buying had a mortgage of 18%, it was just crazy stuff. That was different than now. Now there's fundamental questions and there's fundamental fear. Plus in 1978, I was young, and now I'm not so young. And the big mantra of this election, and we're all feeling pretty good about it, is they're spending our children's money. They're spending our grandchildren's money. And that's very much what's driving a political revolution. But when we put together tonight's panel, it was an eye on how are you saving your children's money? You know, how are you saving your grandchildren's money? What kind of protections can you take? What kind of investments can you make? What kind of outlook do you intake so that you are in a good position to say to them, at the end of your race, I have not merely gathered in, I have grown, and I'm leaving you a legacy not just of wealth, but of responsibility. So let me briefly tell you what we're going to do tonight. Stephen Cooper and I have been on-air guests. In fact, I think everyone here, with the exception of our friends in real estate, have been on the program before, and I will correct that. Because we just have met in the last brief moments here. But Stephen has been before. We've talked about the IRSOP program before. And he's going to introduce you to some concepts which I did not know about when he brought them to my attention. And I thought that's very, very powerful stuff. Phil, you've known Phil for years. I've known Phil for years. And Phil is the best in his business at tangling. If the IRS ever gets mad at me, and if this gang stays around, it's almost certain. I think they've got a list and they're checking it twice. My call is going to go out to Phil. He's going to talk about that. I've already mentioned to you Brian. Brian is my go-to economist. He's the reason the Wall Street Journal puts him on the board of forecasters. He's been ranked #1 for the long term for a long period of time. And I think maybe among the top 2 or 3 guests I have on every week. People love to hear Brian talk about the future. I like the fact that he teaches the undergraduates at Wheaton College. And that he's committed not just to taking care of his clients and growing wealth in the private sector, but preparing a new generation to do the same. Jeff and Fred, as I said, are my new friends, but they know distressed real estate. I'm sorry to say I didn't have a need for people like this until 2 years ago. Now there are new opportunities. There are new opportunities out there for people who know what they're doing, and they do. They have a wonderful record. Robert and Bill, if you listen to KRLA, have been sponsors with me and have been on my program with me for about a year and a half now, almost 2 years. And between them, they have a combined, well, I won't say how many years they have combined. They have enough gray hair that I almost look like I've got brown hair compared to them. When we're done having little presentations, I'll jump up for a second to make sure Brian answers the really tough question with Brian. And you'll have to wait to hear what that is when I come back. Then we're all going to stand up here and we're just going to engage with you. So they've each promised me, on the threat of never, ever, ever being on again, that they will keep in their time frame so we can get to your hard questions and answer those. So get them ready. But let's kick it off with Stephen Cooper. Come on up, Stephen.
Hi there, I'm Steve. Back in 2000, just about 2000, we named this the Entrepreneur Rollover Stock Ownership Plan. That's where the ERSOP comes from, and our website is ersop.com, which is rather important. My partner there. In 1974, Congress passed ERISA, and they said that if you have a corporation, and if a corporation has a real retirement plan, then an individual can be the trustee of the plan's assets. Now, I put the question to you, who is the most trustworthy individual you know? Thank you very much. Now, this was extended in 1983 to unincorporated plans, but it is totally not given to IRAs. And this little bit might be in jeopardy, and I'll get to that in a minute. Okay, first of all, with our plans, you need to make the decision. Are you going to be active or passive? All of our clients are active. They have that entrepreneurial spirit. They're going to be in charge. They're not going to have custodians, there's no banks, no brokers. They're going to make all of the business decisions. We originally designed this for people that wanted to use their retirement money to fund businesses, either existing businesses they have now or new businesses they want to start. Also, if I have time, we'll get into real estate. And you can use your IRA funds to do this once you've rolled them over into one of our plans. But again, you cannot use the IRA vehicle. All of this money is rolloverable. You can use all of this money. Your 401k, pension profit sharing, if you work for the state, teachers' annuities, 403b, 457. There's a couple of things that can't be rolled over, but they're pretty minor. Almost everything is now available. For those of you who are employed and you want to keep that employment, but you have a big 401k account and you wish to use that money, the problem here is the law is permissible but not mandatory. But you could, we have all of these slides up on our website. You could print this slide out, cut our name off the bottom, walk into Employee Benefits Department of your firm, and say, I want one of these. And what they are is an in-service, non-hardship, non-suspension withdrawal. In service. You still work there. Non-hardship's not under the hardship rules because you can't roll that money over. Non-suspension means they don't kick you out of the plan for moving your money to another alternative investment. If they say that they've never heard of it, we'll say here are 50 major corporations that have some form of this. So, including a certain radio station company I've heard of. But anyway, how is this done? There's a statutory exception to the general rule. We all know the general rule, don't you dare touch your money. But there are 23 statutory exceptions. Problem is they're not available. This one that we're using, number 13, is not available to sole proprietors, partners, or subchapter S shareholders. So that leaves us with a C corporation. Also in ERISA, it states that you can only purchase STOCK, and those wonderful LLCs that have been out for a couple of years we've all heard about, they don't have stock. They have membership interest. We established the corporation for our clients. We established the retirement plan to attract you as an employee and any other employees that may become eligible. We submit every one of these plans, unlike some people I can think of, to the Internal Revenue Service. And we secure for you a favorable determination letter after full disclosure, so that if you ever do involve yourself or get involved in an IRS audit, you'll have reliance on exactly that the IRS knew you were doing all of this from the get-go. Okay, now that we've established the corporation and the plan, you wander down to your favorite bank. I can't ask you. Who's your favorite bank? Union. That's a good bank. Anyway, you establish a checking account for yourself, for the corporation, and a second checking account in the name of your new corporation, Inc., profit sharing plan and trust. You and your fetching spouse, if any, as trustees. Then we assist you in getting your money from wherever it's at, the IRA, the 401k, in-service distribution, rolled over and deposited into that trust account. This generally takes about 2 weeks. It takes about a week to do the paperwork, to get the plan and the corp set up, and it takes the balance of the second week to get the money to move. Okay? Now, as soon as the money is set, oh, by the way, we never touch the money. We're a third-party administration firm that sells no investments. And since we don't sell any investments, we don't care what you do with the money. How about investing in yourself? As soon as the money is settled in the trust account, you as trustee write a check for all of it or part of it. In other words, you could write all of it to the corporation in exchange for the first stock certificate. Or you could do half. You could do half over there and put half into ordinary investments. You can set up an account at any one of the brokerage houses that you want. Go into any kind of investment you want. Simultaneously, did it again. Simultaneously, you should write a check for a minimum of $1,000 of your personal funds in exchange for stock certificate number 2, so that you have a personal investment in this. And this becomes very important later on, because that's what the exit strategies are. This is what started this whole thing in 1999. Prior to 1999, my ex-partner and I could not get anybody's accountants to let them do this because, my God, you had to be a C corporation. And the prospect of double taxation was more than they could handle. So in 99, I asked my current partner, who's wandering around here someplace, I hope, exactly how we get around this. We assume that you want to start a business, build it up for 10 years, and sell it. Now, you can be a C corporation for the first 9 years without a double taxation issue. The problem comes when you go to sell. You all know that you can't just sell a C corporation and get full price for the stock because nobody will pay you full price for the stock. They're afraid of any unforeseen liabilities. And if you go to sell it as an asset sale, then the IRS will see the big gain and they'll want what used to be a pound of flesh, I hear it's now £1.50. So, what to do? Well, what she said is, about here, now this is the point, not year 5, but where this is your initial investment of capital from the retirement plan, where the corporation has recaptured that, and you have the corporation then repurchase all of the shares of stock, cash flow permitting. If you're making a lot of money, this will be easy. Fastest we ever had somebody do it was 4 months. We got a lot of clients that haven't done it in 10 or 12 years, in which case it really doesn't matter. But to avoid the double taxation, but that's what you want to do, is you want to have the corporation buy all of the shares out of the retirement plan so that you can elect subchapter S before the double taxation issue becomes too great. Then you'll have essentially two gains, one that's frozen at a very modest level, and a much greater gain that occurs afterwards while you're in S. So when you do go to sell the business, you'll be an S corporation. You'll be selling the business as an asset sale to the next owner, and the big gain will flow to you through the S corporation. And you'll have the privilege of paying taxes on it only once. And you'll get long-term capital gains treatment till the end of the year. Maybe beyond the end of the year. Maybe not as good as it used to be. Now, there'll be a small tax paid on that. Remember that red part? But that too will pass through to you as a deduction to the S-gate. So it's really sort of a big wash anyway. All right. All right, there are other exit strategies. You could just distribute to yourself all of the stock. We had a client this last year or so, the value of the stock got away from them. Instead of being $1 a share, it's now $5 a share. They didn't have the money to buy it back. So they just distributed the stock to themselves. They paid ordinary income taxes on the basis, the original dollar. And then they could postpone paying long-term capital gain on the balance. However, they of course paid long-term capital gains this year because it's still 15%. Yes, you can remain a C corporation forever, especially if you're not making a lot of money. It doesn't matter. There is my favorite Internal Revenue Code section, 33HH10, where it says, I sell you my stock today, and at midnight it turns into assets. It's this much code on one piece of paper. The regulations are this many books on a bookshelf. It is possible to do. Got to have a really good accountant, but you can do it. We've had clients retire, disability. We've had a couple where the spouse took off with it, the quadro. She got the whole retirement plan, the business, and everything. Or you can use our plan and have the next buyer invest his money into the retirement plan, roll it in, buy the stock from you, and off you go. There are three rules of which we must abide. First, you can't screw the plan. The plan must receive fair market value for what it's being invested in. Second rule is no commissions can be charged. And the third is it must be one of the 5 plans that are eligible to do this. Now, they're not up there anymore. They're profit sharing plans, pre-74 money purchase pension plans, stock bonus, thrift savings, and ESOP plans. But the next sentence says, excluded from this definition are all individual retirement accounts. That's why you can't do it as an IRA. And all of our clients are either going to be officers or directors or highly compensated, and because they're entrepreneurs. Now, sorry about that, but I want to warn all of you. These 2 people are out to glom their hands onto your retirement funds. There's a bill in Congress right now where they want to give you a bond, a government bond in exchange for your retirement funds. Let me get off that. So let me make a suggestion to you. Why don't you get your money and your retirement plan out of what is readily available to them? If you have it invested in a business, they're going to have difficulty coming in and getting you to tax you on the full value of the business. There's other non-traditional assets. In the last couple of years, there's been a perfect storm brewing, especially out in the Inland Empire for real estate. Once you've got the money from the profit sharing plan into the corporation can be an active property management firm. And that property management firm can invest, a permissible investment of a C corporation is an LLC. And that LLC, if you're an employee of the C Corp, and if you go to the bank and guarantee the loan, you can have the investment basis in the LLC yourself personally, so that you can take your cash from your retirement plan, run it through the corporation, it becomes the down payment here is cash. I think non-owner occupied right now is 25% down payment, and then you're borrowing 75%. And there are properties out in the Inland Empire right now that are cash flow positive, doing just exactly this. You can have multiple LLCs, probably one for every property. And if you want to really get complicated, you can bring a lot of other people in and help you invest in those LLCs. So that's basically what I've got, and they're kicking me off.
Well, thank you. I'm Phil Liberatore. I'm the IRS problem solver. I'm going to be your best friend. Thanks to the current administration, they're going to hire 16,500 new auditors, thanks to Obamacare. And I've talked with some local offices in Southern California, and they've already hired about 5,000 of them. So it's coming down the pike. And I've been doing this for 30 years now, and I just published a book called An Inside Look at the IRS. I encourage all of you to get a copy of it afterwards at our table. I also wrote an earlier book called God, Money, and You, and I want to encourage you to pick this up as well. It's really easy to read. It's 101 spiritual answers to your financial questions. And there's 3 major misconceptions about money. That's what this is all about tonight. One is that God doesn't care about money. There's 700 references in the Bible about money. 2/3 of the parables talk about money. And 1 out of 6 verses in the New Testament refer to money. So we all know how important that is to God. Secondly, money matters aren't spiritual. But it says in Luke 16:11, so if you have not been trustworthy in handling worldly wealth, who will trust you with true riches? So that's what we're talking about tonight. And finally, money is the root of all evil. No, it's not. Money is... yeah. The love of money is the root of all evil. And that's 1 Timothy 6:10. So I've broken this into great chapters. Getting out of debt, chapter 3. I know a lot of people right now are struggling with that. Getting ahead at work and business, chapters 4 and 11. Saving money and investing, chapters 5 and 10. Giving and blessing other people, chapter 7. And keeping a family budget, insurance, and estate planning, chapters 8 and 9. So I encourage you to grab a copy. Chuck Smith, Jack Hayford, Warren Duffy are just some of the few that have endorsed that book. But let's talk about the IRS. Anybody been audited by the IRS out here? We got a few of you. The national stats used to be 1 in 100. Well, forget that. You could look at maybe 7 out of 100, and that's rising rapidly. As a matter of fact, they've got together 10 regional centers now, and they're called service centers. Of course, the closest one here is Fresno. I've been up there for a tour. By the way, they don't give tours anymore. They used to be really friendly at one time. Remember that in the late '98 when Congress was really pounding on them? Well, guess what? They have a new commissioner by the name of Douglas Shulman, and he's just doing the opposite. He's instructing all the revenue officers, we got to pay for all this administration spending, right? Who's going to pay for it? You and me, the taxpayers. Isn't that great? Which is why I ran for Congress recently for the 42nd District, and we're fighting to take back America. I'm going to continue the fight. I'm starting a radio show on KRLA starting October 3rd on Sunday nights at 9 called Liberty Speaks. So you'll be hearing a lot about me. But it's not about me, it's about you and me. These are our hard-earned money that the government wants to take. Because we all know businesses are the one that keep this economy going. And right now, everybody's really nervous. We don't know about these Bush tax cuts that are going to be expiring at the end of the year, what that's going to mean to you and me. I brought so much material tonight, I don't even know which way to go right now, but I'm just going to keep going, all right? Let me tell you about the Dirty Dozen. This is the Dirty Dozen projects the IRS are just looking out for right now. And let me just touch upon this a little bit. These are the Dirty Dozen projects that the IRS is looking for. Number 1, return preparer fraud. There's a special, these are all special projects now. They're looking for preparers that are under suspect, that are not giving proper advice. And what they're doing, what they do, and I don't know if anybody's been caught in one of these, they'll come in and literally shut the firm down. Has anybody been part of one of those sweeps? They'll end up auditing all the tax preparers' clients at one point. Anybody caught in this sweep? I've seen a number of them come into my office, and you can see that it's just really unusual, some of these returns. The second Dirty Dozen is hiding offshore income. And a couple years back, anybody have offshore accounts? Just want to see how sophisticated we are there. Okay. Anyway, they were really doing a sweep on that with debit cards that people had overseas. Phishing. Now be aware of this. There's bogus websites that look officially like the IRS. And sometimes you might get an email that says, hey, you got a refund, it's sitting here, just hit the button and you'll get it. That's all bogus. They're looking to crack down those kind of guys. Another one is filing false or misleading forms. And again, there's some tax preparers out there doing that. Another big one is abuse of charitable organizations and deductions. I've had some people come in where they've started their own charitable organization and they're, of course, giving very heavily towards that. That's also called a sole corporation, but that's something else. Abusive retirement plans. These guys will tell you about that. They're experts in this. Disguised corporate ownership. Zero wages, where they'll file a return with no wages on it, but a large withholding. Misuse of trust. This is a big one now. I don't know how many of you have trusts out there. There's some preparers out there and some promoters as well, saying, hey, you could live out of your trust, you could write checks out of your trust, you could bypass income taxes through your trust. Just be aware of some of those schemes out there. And also there's a fuel tax credit scam that's going out as well. So those are some of the tidbits that the IRS is hitting right now. But I've been in business for 30 years. I employ a number of ex-IRS agents that work for me, and they see the grass is greener on the other side. We also want you to get ahead of what the IRS is doing. We want to keep you abreast of that. I've got a couple clients in the audience, and I appreciate those guys being here. Getting to know the IRS. Well, look at that. Isn't that funny? That's Obama's hand, by the way. And I know you heard his threat recently. Everybody making over $200,000, watch out. That's you that they're shaking, and I'm sure that's a lot of you in the audience right now. So we really got to be on top of our game. Who is the IRS? Of course, it's the largest federal bureaucracy in the country. It employs over 100,000 employees. And they do have a mission statement. And their mission statement is, we want to help you. Have you heard that before? They also have a strategic plan. Listen, look at this. 38 pages, they publish a strategic plan. These guys are really in business to do business. And let me tell you the two goals that they have. We know what their mission is. Provide American taxpayers top quality service by helping them understand and meet their tax responsibilities and enforce the law with integrity and fairness to all. Do you believe that? Anybody get knocked on the door by an IRS auditor recently? They're visiting a lot of delinquent accounts. Anybody get a knock on the door? See me afterwards, will you? We just love the IRS. We work with them. We got great relationship with them in the local offices, and they're really a lot of fun to work with. But you got to know their game. It's like preparing for the big game. You got to know what they're up to. Anyway, their two goals is this: improve service to make voluntary compliance easier. Anybody experience some improved service from the IRS? They train you the format